Welcome back to the deep dive. Today, we're plunging into a sector that's, well, it's always had this almost magnetic pull: mining.
Mhm.
You think instant riches, those stories, they really capture the imagination, make headlines. When the mining sector really gets going, it can be quite something.
It really can. But there's another side to it too, isn't there?
Exactly, the often overlooked part, and it's vital because it's often counter-cyclical. Many mining stocks can actually be a valuable refuge when other markets are, well, heading down.
It's a unique beast, definitely.
Yeah.
Highs and lows, but also that surprising stability sometimes.
Yeah, it behaves so differently from, mainstream equities. It demands a particular kind of insight.
That's it.
Absolutely. And our mission today, well, it's all about giving you a true shortcut, getting you well informed about this dynamic sector.
Mhm.
We want to equip you with the fundamental knowledge, help you understand its unique dynamics, and honestly, some genuinely surprising facts that are pretty crucial if you're an investor.
Right. And to do that, we've really gone deep into Michael Coulson's An Insider's Guide to the Mining Sector.
Ah, Colson's book. Good one.
Yeah, specifically the second edition, the revised and expanded one from 2008. Coulson, he brings over 30 years of experience. Started at James Cable back in 1970 on their legendary mining desk.
Wow, James Capel.
Yeah, focused on South African gold and independent research. This book, it really covers the whole gamut: investment rewards, the pitfalls, mining history, the newer players like China and India.
And he makes a strong case, doesn't he, that mining should be core for investors.
He really does. Makes a very convincing argument.
So, okay, we've sort of looked at the global picture where the action is, but it begs the question,
Hmm.
what are they actually digging up, and how do we even start categorizing all this stuff for investment?
Well, Coulson stresses, and it's key, that mining is inherently international.
Right.
As an investor, you just have to have that international outlook, and as he puts it, an open and inquiring mind to make good judgments. It's not just about your home market.
Makes sense. You need that wider perspective.
Exactly. And connecting that, the source points out, look, mining happens almost everywhere, but only a few countries have industries big enough, or let's say stable enough, to be ideal for investors.
The usual suspects, as they call them.
Yeah, the usual suspects.
Yeah.
Traditionally, you're looking at Australia, Canada, South Africa, the UK, and the US.
Okay, the UK is interesting, though, because they don't really do much mining anymore, do they, since coal kind of faded out?
Barely any actual digging now.
Yet London is home to, what, four of the world's biggest mining groups? Anglo-American, BHP Billiton, Rio Tinto, Xstrata. How does that work? London, no mines, but this huge global presence.
It's all about the finance, really. London's banking system is incredibly sophisticated, super experienced in funding mining projects all over the world.
Oh.
And operating as a UK company, well, it can actually lower your cost of capital quite significantly compared to other places. That's a massive draw.
So it's not just history, it's a real practical financial edge. That makes sense. Okay, what about Australia then? Known for stability, sure, but I seem to remember some big challenges too.
Australia definitely offers that economic and political stability, which is great. But yeah, it's had these ongoing issues, especially around the environment and um, Aboriginal sacred sites.
Right, like Jabaluka.
Exactly, the Jabiluka uranium project. Huge problems there because it was near a national park, and crucially was on land important to indigenous communities. It's a tension that keeps coming up.
Mm-hmm.
Plus, you've got those strong historical financial links with British investors
Yeah,
going way back to the Western Australian gold rush.
got it.
Uh-huh.
And Canada, they've got this reputation, right? Aggressive fundraising, big exploration finds like those diamonds.
Oh yeah, the diamond discoveries were huge.
But then, Bre X,
Yeah.
that shadow looms large. How did that whole fiasco impact trust in their mining industry?
Oh, Bre X. Yeah,
Mhm.
we'll dig into that specific story later. But it fundamentally shattered investor trust in the industry, in the brokers.
Mm.
It was massive.
I bet.
Before Bre X, Canadian investment banks were, well, known for being pretty aggressive fundraisers, especially for the junior explorers. The scale of that fraud, it just forced the whole industry to work incredibly hard to rebuild confidence, led to much stricter regulations eventually.
Okay. And South Africa. Always complex, especially with the history of apartheid. Post-apartheid, the book points to three key areas that really reshaped mining there. What were they?
Right, post-apartheid, the government really focused on three main things: mineral leases, black empowerment, and mineral royalties.
Okay, let's break those down. Leases first.
With leases, the government wanted to nationalize the ones that weren't being worked. Sort of a use it or lose it policy.
Yeah.
Stop companies just sitting on valuable land indefinitely.
Makes sense. Black empowerment.
The goal there was 26% ownership for previously disadvantaged groups. A crucial aim. But the source notes, well, sometimes the way it played out looked a bit like the enrichment of, say, Russian oligarchs.
Oh.
It sometimes ended up favoring established black business interests, maybe politically connected ones, rather than spreading the benefits more widely, like to grassroots communities or workers directly.
Right, so the intention was good, but the execution maybe created a new elite.
That was the criticism, yes, that it didn't always achieve the broad-based empowerment intended, which, for investors, raises questions about transparency and long-term stability.
Ah, definitely. And the third thing, royalties.
Yeah, royalties.
Yeah.
The initial proposals were based on revenue, which the industry argued was really damaging, especially for marginal lines. So they eventually shifted to a profit-based system, capped at 5% for refined metals and 7% for unrefined. A bit more workable.
Okay, that covers the traditional players. But the landscape's always changing. The book talks about new frontiers, China, Russia, Kazakhstan. What's the big takeaway about these places? Potential versus risk.
Yeah, that's the core tension. These new frontiers, they've got huge potential, vast resources, often underexplored. But, and it's a big but, they come with significant risks because they're not Western-style democracies.
Right. Different rules, different history.
Exactly. You've got a history of state control, sometimes even outright expropriation of private property without compensation. That's a massive red flag for investors used to, establish legal protections.
A critical warning, definitely. So China specifically, foreigners can invest, right, through H, B, or N shares. What are those and what's the advice?
Right. HBN shares, they're just different classes for foreign investors listed on different exchanges like Hong Kong for H, Shanghai Shenzhen for B, New York for N. The book's recommendation, basically stick to investing indirectly. Go for companies incorporated outside China, but which have strong, reliable local partners inside China.
So a buffer, essentially.
Kind of. It aims to mitigate some of that direct legal and political risk within China itself.
Okay. And Russia. Big on strategic metals, I know. But what are the specific worries for investors there?
Russia definitely sees gold as strategic, wants to boost its reserves, which could be good for the gold price, theoretically. But the source points back to the Wild West days after the Soviet Union fell.
Yeah.
There were incidents where legitimate shareholdings just vanished, removed from company registers by directors. That level of corporate governance risk, well, you absolutely have to factor that in.
Wow, your shares could just disappear. That's serious. What about Kazakhstan? You see Kazakh companies listing in London now, even without strong historical ties. What's the story there?
Yeah, it's a more recent thing, Kazakh companies incorporating in the UK, listing in London. But the underlying dynamic is similar to Russia, maybe. The Kazakh government increasingly wants control over resource development.
Any examples?
Well, the book mentions Oxus Gold shareholders, who basically got caught in a state grab by the Uzbekistan government where their project was. It shows that even with a London listing, the risks in the actual country of operation are still very real. You can't just look at where it's listed.
Got it. So jurisdiction matters more than the stock exchange ticker. Okay, that was a great tour of the global mining map. Let's switch gears. What are they actually digging up? How does Coulson break down the metals and minerals for us?
He uses broad categories. You've got your major industrial metals, then precious metals, but excluding gold, which gets its own focus.
Interesting.
Then gold itself, minor industrial metals, and finally non-metals, which includes energy minerals like coal and uranium.
Okay, let's start with the backbone, the major industrials. Copper, zinc, lead, tin, nickel. What's the key investment idea here beyond just what they're used for?
The core insight is their direct link to the global economy, manufacturing, construction cycles.
Right.
Understanding those demand drivers is everything. They really are the economic backbone. Copper is everywhere. Zinc is crucial for galvanizing steel. Lead mainly in batteries now. Nickel for stainless steel.
Any quarks?
Well, zinc, for instance, is often found in ore bodies with lead and silver.
Yeah.
So the prices can get complicated. If zinc shoots up but lead is flat, it affects the mine's economics. Tin, on the other hand, he notes, has had a pretty unexciting track record price-wise.
What about aluminum and steel? Huge industries, but the book puts them slightly aside. Why?
That's right. Aluminum comes from bauxite, steel from iron ore.
Hmm.
Coulson argues they're really processing industries, more like engineering than direct mining. in some ways.
Oh, okay.
Their prices aren't driven by the market in quite the same way as base metals traded on exchanges like the LME. It's a lot more involved in the processing. Long-term contracts play a bigger role.
Gotcha. Moving to precious metals, but not gold for now. Silver, platinum. Silver's got that history as money, store of value. You'd think that would make it strong, but the book says its performance has been disappointing.
Yeah, it's interesting. Because of its history as money, there have been huge stockpiles of silver built up over centuries. So even though it's had a bit of a revival recently, its price performance has generally been underwhelming, often well below where it was back in, say, 1984.
So too much existing supply hanging over the market.
That seems to be a big factor. That massive above-ground stock can really dampen price rises even when new industrial demand picks up. Those silver bulls are always optimistic, aren't they?
Huh, true. What about platinum? I heard it's geographically concentrated. What does that mean for investors?
Yeah, that's a really critical point. South Africa produces something like 80% of the world's platinum. Russia's the other main player.
Wow, 80%.
Yeah. That heavy concentration creates significant investment risk. Any political issues, labor strikes, anything like that in just one country, South Africa mainly, can dramatically hit global supply and send prices soaring or collapsing.
High stakes. And diamonds, always glamorous. Can regular investors actually play this market easily?
Well, historically, De Beers controlled everything through their central selling organization, managing supply to keep prices stable or high.
Right, the cartel, basically.
Essentially, yeah. But from a stock market perspective, since De Beers went private, there are very few direct plays left. Big miners like BHP or Rio have diamond mines, sure, but it's a tiny part of their overall business, maybe 2.5% of profits. So directly investing in diamonds through listed shares is pretty limited now.
Okay. Now for the really interesting, maybe slightly scary category, minor metals. High hopes, high risks. They're often called metals for the future. What's the lesson from that tantalum bubble back in the early 2000s?
Oh, tantalum is a classic critical lesson. Its price went absolutely crazy in 2001-02, driven by demand for mobile phones. Then it crashed spectacularly.
Ouch.
The takeaway. For these minor metals, the spot markets are often incredibly thin, meaning not much is traded day to day. Price bubbles can inflate and burst really fast, and if a company gets caught, they might have to issue tons of new shares at rock bottom prices just to survive, massively diluting existing shareholders.
So timing is everything, and getting out before the music stops.
Timing is vital, as Colson puts it. Getting caught at the peak can be absolutely devastating.
And cobalt, known for being super volatile. What's the cautionary tale there?
Cobalt, yeah, used in rechargeable batteries, very volatile prices. The book mentions the failure of the Nkana Dumps project in Zambia. Looked good on paper, but it relied on that thin spot market, got tangled in ownership disputes. It just collapsed. Big investments written off.
Another example of thin markets and political risk.
Exactly. It highlights the danger when you're dealing with these less liquid markets and where governments might suddenly step in.
What about tungsten and magnesium? What's their story?
Tungsten's important, strategic uses, cutting tools, but historically its price was kept low because the US, Russia, and China held massive strategic stockpiles.
Ah, overhang again.
Yep. Magnesium has potential, used in lightweighting cars, electronics, could be a future major metal, but actually scaling up production from new projects, like some in Australia, has proved really difficult and costly.
So the overall message for minor metals is
Caution, extreme caution. They're often seen as metals for the future, but as the book says, a great deal of caution is, therefore, required. Their small market size makes them prone to wild swings. Don't bet the farm.
right. Finally, energy minerals, often controversial. Coal and uranium. Coal's everywhere, but what are its main challenges now?
Coal's global, fundamental for electricity and steel. But it faces huge environmental headwinds. The pollution issue is massive. Plus safety concerns, thinking about things like the mine disasters in China. And it's very cyclical, tied tightly to economic growth.
And uranium. It had this amazing comeback despite the controversies around radiation and waste. But the book warns about a bubble-bursting risk. Why, if nuclear is seen as carbon clean...
Yeah, it's a paradox.
Yeah.
Nuclear's carbon credentials have driven this resurgence since 2000. But Colson warns, uranium itself isn't actually scarce, geologically speaking. Yeah. And with prices having gone up so much, there's now a massive increase in new mine output looms as projects get developed. That creates a real risk that supply could overwhelm demand again, bursting the current bubble, just like happened back in the 1970s after an earlier price spike.
So the cure for high prices is high prices, leading to more supply.
Often, yes, especially if the underlying resource isn't truly rare. So while uranium's story is compelling, you have to be aware of that potential supply surge.
Okay, this brings us neatly to the art of the deal. Investing, shares, markets. Let's talk gold, the gold standard of investment. What really makes gold unique as an asset?
Gold really does have unique characteristics. It's seen as a store of value, a hedge against financial chaos, against inflation. It can do really well even when other markets are, in free fall. That makes it a powerful diversifier in a portfolio.
And central banks, for ages, it seemed like they were selling gold. Has that changed?
It really has shifted. For a long time, yeah, many Western central banks were selling, focusing on currencies like the dollar. But now you see big players, especially like China and Russia, actively buying gold, building up their reserves.
Interesting. Why?
Well, partly diversification away from the dollar, maybe. But also, it underlines its enduring role as a safe haven asset in uncertain times. You just have to remember things like Japanese citizens rushing to buy physical gold in 2002 when government deposit insurance was cut back.
Or even FDR confiscating gold back in 33.
Exactly. Controversial, but done to prop up prices during the Depression. These events show gold's deep psychological appeal during crises.
So what actually moves the gold price day to day besides just general fear or greed?
Key factors.
Yeah.
Well, historically, there's often been an inverse relationship with the U.S. dollar. Stronger dollar, weaker gold, generally.
Okay.
Interest rates are huge. Gold pays no interest, right? So when interest rates are low, the opportunity cost of holding gold instead of interest-bearing assets is lower, making gold more attractive.
Makes sense.
And hedging by mining companies used to be a big factor. Mines selling their future production forward. That added supply to the market, often pushing prices down. But that trend has largely reversed in recent years.
Right. So understanding the metal is one thing, but for investors, it's usually about the shares. How do gold shares fit into a portfolio? Are they just a leveraged play on the gold price?
They often are leveraged, yeah, but it's more nuanced. Gold shares often have a negative correlation to the movement of ordinary industrial equities.
The counter-cyclical point again?
Exactly. So they can act like an insurance policy for your wider portfolio. They might go up when everything else is going down. Plus, you get potential for company-specific growth, finding more gold, cutting costs, and maybe even dividends.
Yeah. Okay, let's talk markets. Where do you trade these things? London's had a big comeback as a mining finance center, you mentioned. What drove that?
London's really reestablished itself. Partly it's that sophisticated financial ecosystem we talked about, but also the alternative investment market, AM, has been huge for smaller companies. It's flexible.
Right.
And London's reputation has recovered so well that you see major companies from places like Kazakhstan, Ukraine, choosing to list there now. They want access to that deep pool of capital and experienced investors.
And Toronto, still the king of the juniors.
Arguably, yeah. Toronto still has probably the most active junior mining sector anywhere. A big part of that is helpful tax breaks for Canadian investors putting money into exploration.
Ah, incentives.
Definitely helps. And after Bre X, the TSX Venture Exchange really did tighten up its regulations, which helped rebuild trust over time.
What about Australia? How does their investor culture differ, especially regarding projects outside Australia?
Australia's got a familiar Anglo-Saxon legal system and an efficient electronic settlement system called CHESS, so it's comfortable for many international investors. But interestingly, Coulson notes that Australian investors themselves tend to be less comfortable with mining juniors which have sizable interests overseas.
Really? Why is that?
Maybe a preference for what they know? Hard to say exactly. But it means sometimes Australian companies with big overseas projects actually look to London or Toronto for funding, where investors might be a bit more globally focused.
Interesting dynamic. Okay, so size. Does it matter? The book talks about the giants, the medium players, the small explorers. What's the gist for each?
Size definitely matters, but in different ways. The large diversified groups, your Anglos, BHPs, Rios, Xstratas, Vedantas, they offer diversification across different metals and countries. But don't think that means stable earnings. They're still very exposed to commodity price swings across the board.
Right, still volatile.
Oh, yeah. Then you have the medium-sized miners. Market cap, say, 250 million to 1.5 billion, roughly.
Yeah.
These would be really exciting, especially if they bring a new high-margin project online, like Antofagasta did with copper in Chile. Huge growth story. They offer a mix of some scale, but still significant growth potential.
And the small guys, the explorers.
Pure high-risk, high-reward. That's the name of the game. The attrition rate is incredibly high. Many just won't make it. They'll run out of money or not find anything economic. But the potential payoff can be dramatic, absolutely. Think of the Canadian diamond boom or the uranium surge more recently. That's where you saw some small companies go ballistic. Their journey relies heavily on raising equity or maybe getting non-recourse debt,
Non-recourse, meaning
meaning the lender can only claim against the specific project's assets if it fails, not against the whole company. So it's higher risk for the lender too, and usually more expensive financing.
got it. What about these projects that refuse to die? Sounds intriguing. Zombie projects.
Kind of. It's about persistence and how things change. These are old projects maybe explored decades ago that get dusted down and reevaluated when metal prices shoot up or new technology makes them viable or political situations change.
Any famous examples?
The Teka copper cobalt project
Yeah.
in the Congo is a classic. Took something like 40 years, maybe more, to finally get into production because of endless political problems and market swings.
40 years.
Yeah. Or the saga of Southern African offshore diamonds. That's been on again, off again for decades as recovery technology improved. It just shows you patience is key in mining, and what looks dead might just be dormant.
Great point. Which leads us perfectly into the madness in the method, learning from history, understanding the data. The big theme here seems to be that history repeats itself in mining markets. We have to talk about Bre X in more detail. I remember the headlines, what actually happened, and what are the absolute must-learn lessons.
Bre X. Yeah, the Busang gold project in Indonesia back in the 90s.
Yeah.
One of the biggest frauds ever. Essentially, the core samples were systematically faked
How?
by salting, sprinkling gold dust, apparently from placer gold bought locally, into the crushed rock samples before they were sent to the lab. Done with incredible precision, apparently, to make the grades look consistently spectacular, but still sort of geologically plausible.
Unbelievable.
And then the whole thing got even more dramatic with the exploration manager, Michael de Guzman, mysteriously falling out of a helicopter right before the fraud was officially exposed.
Like something from a thriller novel. So the lessons for investors, what should we take away?
Lesson 1, independent. Due diligence. Cannot stress that enough.
Right.
And maintain healthy skepticism. Even when big, reputable companies seem interested, major miners were looking at buying Bre X, but it was their due diligence drilling that actually uncovered the fraud.
So don't just follow the herd, even if the herd includes giants.
Exactly. And that old saying, the wish being father to the thought, it was clearly happening. People wanted to believe in this incredible discovery. If something sounds too good to be true, well, you know the rest.
Yeah. It's sobering that the book suggests a scam that big could possibly happen again.
Well, regulations are tighter now, for sure.
Sure.
But human nature greed. The lure of easy money doesn't change much, so vigilance is always needed. New scams might just be more sophisticated.
Okay. Then there was the Australian nickel boom in the late 60s. Sounds like pure mania. What characterized that?
Oh, total speculative frenzy. Classic bubble. You had stocks like Poseidon go from like 10 cents to over $120 in a short time.
Wow.
And this weird thing called closiology popped up.
Closiology.
Yeah, companies whose land was simply near a known discovery saw their shares rocket, often without any proof they had anything themselves. Just being geographically close was enough. Stocks like Tasmanex, Endurance Mining, wild speculation, often with little or no actual viable nickel underneath. Pure hype.
Sounds just like the dot-com boom later on, where just having .com in your name was enough for a while.
Exactly the same psychology. The source makes that direct link. Bre X, the nickel boom, the internet bubble. It highlights that the broad structure of a stock market boom regularly repeats itself. Not just over time in the same sector, but across different sectors too.
Recognizing those patterns is key then.
Crucial. If you understand the history, you might spot the signs of irrational exuberance developing next time.
So, given all this potential for hype and fraud, how do we actually interpret the numbers sensibly? When a mining company releases results, what should we look past the headline profit figure for?
Good question. Look deeper. Dig into the details. Are exploration costs rising sharply? How are currency fluctuations impacting things? And increasingly important, look for the environmental rehabilitation provisions on the balance sheet.
The cleanup costs.
Yeah, the money set aside for future site cleanup. It's becoming a much more defined and significant liability for miners, reflecting that growing pressure for environmental responsibility. It affects the real bottom line.
And exploration reports, all that jargon, northing, easting, RL, dip. How can an investor make sense of it?
It can look intimidating for sure. Northing and easting are just map coordinates for the drill hole.
Wow.
RL is the elevation. Dip is the angle of the drill hole.
Okay.
Key things to look for. The drilling method, reverse circulation, RC, is faster and cheaper.
Yeah.
Diamond drilling gives you a solid core sample, generally better quality. And look for phrases like open at depth or open along strike.
What do those mean?
They mean the mineralization, the good stuff, seems to continue beyond where they've drilled so far. It indicates potential for the deposit to be bigger. Also, watch out for bonanza gold grades, super high numbers. Sometimes they're real, sometimes they might be excluded from the average calculation to give a more realistic overall picture.
Right. Don't get dazzled by one amazing number. What about reserves versus resources? They sound similar, but they're not. Why is the distinction so important?
Absolutely critical distinction. They have precise definitions under codes like JORC in Australia, CIM in Canada, SAMREC in South Africa. The core difference is the level of confidence, based mainly on how much drilling has been done.
So reserves are more certain.
Much more certain. Mineral reserves, proven and probable, have enough detailed drilling and studies done to show they can be mined economically right now, under current conditions, prices, technology, permits. Mineral resources, measured, indicated, inferred, have less certainty.
Inferred being the least certain.
Exactly. Inferred resources are based on limited drilling, more geological interpretation. They might become reserves with more work, but there's no guarantee. And some regulators, like the SEC in the US, historically didn't even allow companies to report resources publicly, only proven and probable reserves, because of that lower certainty.
That's a huge difference for valuation. So how do you value a mining share, especially the explorers with no reserves yet?
Tricky. For the big, diversified miners, standard price-earnings ratios can work, maybe. But for single mine companies or developers, it's tougher. Net present value, NPV, is common.
Discounting future cash flow.
Right, based on estimated production, costs, metal prices, discounted back to today's value. Very sensitive to assumptions, though. In the gold sector, you also see metal value per share, basically the value of the gold in the ground divided by the number of shares.
But that has pitfalls.
Big time. It doesn't account for the cost of getting it out. High-cost ounces might look cheap on a per-ounce basis, but they might never be economic to mine. You need to apply a hefty discount based on viability. And valuing pure exploration plays, that's incredibly hard. It's often more about sentiment, drill results, management track record, very prone to that irrational exuberance.
So where do you get reliable information if mainstream newspapers are cutting back on mining coverage?
Yeah, the Financial Times, for example, covers much less mining than it used to, but there's a wealth of specialist sources online. Websites like MineWeb, Minasite, Gold Eagle, Kitco, they're excellent.
Good tips.
And don't underestimate company resources. Investor relations sections on their websites, signing up for their email news releases, that's direct information.
Given all these complexities, the cycles, the risks, the valuation challenges, what's a sensible portfolio strategy for mining? How should you allocate?
Coulson suggests a balanced approach. Maybe have a core holding, say a quarter to a third of your mining allocation, in the large, diversified companies. They offer some income, a bit more stability, relatively speaking.
And the rest?
Then, a smaller, more speculative slice can go into the junior miners, the explorers, hoping for those dramatic returns. But keep it small, manage the risk.
Diversify by metal or country.
He recommends diversifying by metal rather than country, because political risk can hit an entire country or region at once. Spreading across different commodities gives better diversification.
That makes sense. Any other tools?
You could also consider exchange-traded commodities, ETCs. They give you direct exposure to the metal price itself without the company's specific risks of mining shares.
Right. And any final practical tips on dealing, buying and selling shares in these different markets?
Just be aware it can be complex. Australia has its GS system. South Africa uses straight. These are the electronic settlement systems. Canada sometimes has hold periods on newly issued stock, meaning you can't sell it for a while.
So know the rules or use a good broker.
Exactly. Having a broker who really understands the specifics of international mining stock dealing could be very valuable.
Okay, so let's wrap this up. What does this all mean for you, the listener, the investor? Mining is clearly unique. It's cyclical, it's global. Navigating it successfully seems to need that mix of history lessons and careful analysis.
That's it, precisely.
Yeah.
And Michael Coulson actually boils down a lot of this wisdom into 10 key points for profitable participation. They're really timeless insights.
Let's hear them. Number 1.
Mining shares are often like the underlying metal. They follow the commodity price. It's not for the faint-hearted. Expect volatility.
3.
Never trust a mining engineer, except your own. Basically, get independent verification.
4,
Don't be afraid to take profits. Sell when things are booming.
5,
Liquidity can vanish,
Yeah.
especially in small stocks you might not be able to sell when you want to.
6,
Environmental and political issues are critical. They can kill a project.
7.
The geology matters hugely. It
Mm.
dictates the economics. Mining bull markets often build slowly, then spike fast, and the bear markets can be just as quick on the way down.
9,
Mining shares often bottom out before the metal cycle turns up. Look for those early opportunities.
and number 10.
Never fall in love with a mining share. It will invariably jilt you in the end. Stay rational. They seem simple, maybe, but sticking to them is hard. They really are hard-won lessons from decades of experience in this very tough sector.
Absolutely. And that brings us to our final thought, drawing on a metaphor Coulson uses, the last glass of champagne at a party. What does it mean for you to consciously decide to be gone before that, leaving that last glass for someone else? How can the lessons from Bre X, from the nickel boom, empower you to see the warning signs, to act decisively knowing that, well, parties do end and midnight does strike? Something to ponder as you look at your own investments.
A sobering but useful thought.
Indeed. Thank you for joining us for this deep dive into the challenging but potentially rewarding world of mining. We hope you feel better equipped to navigate those dynamic markets.
Hope it was helpful.
We'll see you next time on the Dip Dive.